All right, we continue with classified balance sheet. And classified balance sheet is basically how we properly organize a balance sheet. And oh, these guys, all right, yeah. Come on in. Welcome to class, right? So, we organize what's called the standard classification. And the standard classification is to divide assets and liabilities into short-term and long-term. Short-term is called usually current. So, sometimes we call them short-term, we sometimes call them short-term assets and short-term liabilities. Sometimes we call them current. So, if you like, you can write that current equals short term. So, you divide assets to short term and long term. And within long term, you got two. You got long term investments and property, plant, and equipment. And I'll be explaining these within the next half an hour. You also have short-term liabilities and long-term liabilities. All right, so now we explain. Oh guys, all right, we're trying to explain to you current. Current means short-term. Short-term means within 1 year, means 1 year or less. So, a short-term asset is an asset which will be converted to cash within 1 year or consumed within 1 year. For example, you prepay rent for 3 months. The prepaid expense is an asset and it's a short-term asset. If you buy insurance for 6 months, insurance for 6 months is prepaid insurance, is a current asset. If you buy 2-year insurance, a 2-year insurance, the first year is a current asset and the second year is a long-term asset. Okay? So, if you have a lease, again, the first year is going to be a short-term liability. The second and the third year will be a long-term liability. So, the first piece is that assets that expects to convert in cash within 1 year or the operating cycle. Operating cycle in accounting, in finance is called the cash cycle. And a cash cycle is the cycle of getting cash, converted into inventory, then sell it, and then collect cash back. So, from cash to product to customer to collecting cash back. So, from cash to cash is called a cash cycle. Here is the operating cycle, is the average time that it takes from the purchase of inventory to collection of cash from customers. So, the operating cycle for a retailer like 7-Eleven could be maybe 2 weeks. So, within 2 weeks, they're going to purchase, they're going to sell, and they're going to collect cash. Okay? So, for some businesses, the operating cycle is very short. 1 week, 2 week, 3 week. Okay? For other businesses, it's going to be relatively long. Maybe they have to produce something, they got to manufacture. Let's try rice. Rice, I don't know, let's say it grows for 3 months or 3.5 months it grows. So, you have cash. All right, girls, step right. Okay, move and step right. Okay, move and step right. Or go out, okay? Yeah. Move away or move out, okay? Or move out front, okay? But enough, it's not a child care facility. It's called university, okay? All right, so you're growing rice. Yeah, you still keep moving. You're growing rice. you gotta take some cash. With the cash, you gotta buy the grain. After that, you have to plant the grain. After you plant the grain, you wait it for 3 months to grow. After that, you gotta collect the grain. Then you have to sell the grain. And no, move out, yeah. What is it you're waiting for? Anywhere, on the back, on the front, doesn't matter. And after that, you have cash. You collect the cash. And this can last about 5 months. So maybe you buy the grain, you seed it within 1 or 2 weeks, it grows for 3.5 months, then you collect it, then you sell it within 2 weeks, and then you collect your cash within 2 weeks. So operating cycle is going to be 4 or 5 months. Example of an operating cycle that could be long is wine. You gotta grow the grapes, then you gotta collect the grapes, then you gotta ferment the grapes, then you gotta bottle, and then you gotta wait for the wine for maybe 6 months, maybe a year, maybe 2 years. So a wine cycle could be 1 year, could be 3 years, sometimes could be as much as 5 or 10 years, okay? The French will know a lot about wines. So, but usually most businesses will have a very short cycle, 1 or 2 months. So the typical rule is if it's within 1 year, it is short term. Only rarely the operating cycle will be more than 1 year. This will be an exception, and I'm going to use the exception. So within less than a year, you call it current asset. Again, if it's within less than a year, you call it current liability. Alright, so which are the current assets? Examples. The most prominent ones will be cash and cash equivalents. So you get cash in the bank or cash in the register. That's counts as short-term, as current. Next one, short-term investments. These are investments which you intend to sell within the next 12 months. So you intend to sell it for 2 months or 3 months or 5 months. So you bought, you know that you don't need the money now, you invested the money for 2 months, maybe you simply put it in the bank, and you got a bank deposit, 2-month bank deposit, or certificate of deposit, we call it CD. In that particular case, you count it as a short-term investment, and it's a current asset. Next one, in a trade account receivable. This is the same as what we've been studying for the last 6 weeks, is the same as account receivable. When you have business, when you deliver a good or a service to customer, and the customer will pay later, we call this account receivable, and we call these trade accounts. So if you have to collect from customer within the next 12 months, you classify it as current. Next one is inventory. Inventory is a good which you purchase with the intention to sell. Everything you see in 7-Eleven which is for sale is inventory. Water, coffee, tea, chocolate, whatever is in 7-Eleven, and you can buy, for them it's inventory. So inventories are goods which are available for sale, okay? And that's inventory. Now, if you are a real estate broker and everything you're selling is houses, the houses that you have and you intend to sell within 1 year, the house is also inventory, okay? If you're a car dealer, you have many cars. Each car, again, if you intend to sell it within the next 1 year, counts as inventory. Same thing with a motorcycle dealer. You can go to the Honda dealer here in Phuket town, and they have maybe 50 motorcycles. If they want to sell, it counts as inventory, okay? So, if it's a good you want to sell, it's inventory. And the next current asset is prepaid expenses, which you will use within 1 year. So you may buy 2-year insurance. The part within the next 12 months is current asset. If it's more than 12 months, becomes long-term asset. So you have to separate. If it's more than 12 months, you have to separate. Same thing with liabilities, coming a little bit later. And you do the current assets, you list them all, and you do the total. So you have current assets, you total and say total current assets. So before, we just list all assets and say total assets. Now, we list all current assets and say total current assets. Then we list all long-term assets, say total long-term assets. And then we say total assets. So we divide things into current and long-term. Review question, we skip, we don't need that one. Long-term assets, and long-term assets is divided into long-term investments. And long-term investment is when one business purchased the stock of another business. So these are investments in stocks and bonds of other companies. So when you buy a stock of another company, or when you buy a bond of another company. So can you translate stock or bond? You can translate. Yeah, well, go ahead and translate. You got the stock? Okay, loud. Okay, you understand what stock is? And bond? Alright, so this is stocks and bonds. So stock is essentially a share. Alright, you got it? Stock, a share of ownership of a company. In this particular case, one company buys the share of another company. Okay? And similarly for bond, one company buys the bond of another company. So these will be investments in stocks and bonds. The next one will be investment in long-term assets, such as land or building. And here is the key, here's the key, not currently used. So this is an asset, you buy it, but you don't use it now. For example, Building 7 in university is currently used. So it's a different story. It's called property, plant, and equipment. It's coming next, property, plant, and equipment. But if the university buys a piece of land out there to make more dorms, but now they don't use the land, they don't do construction, they don't do anything, it counts as a long-term investment. So, whether it's a long-term investment or property, plant, and equipment, depends whether you currently use or not currently use. If you don't currently use, it's a long-term asset. If it's currently used, it's property, plant, and equipment. And that's it. Property, plant, and equipment. Okay? And first, it's got a long useful life. Long means more than 1 year, and is currently used in operation. Currently used, it's property, plant, and equipment. So, if you have land, you cannot say whether it's investment or property, plant, and equipment until you ask and answer the question, is it currently used or not currently used? Same for a building. If it's currently used, property, plant, and equipment. If it's not currently used, becomes long-term investment. Okay? And if you have property, plant, and equipment, you have depreciation, and you also have accumulated depreciation. So, keyboard is going to be used more than 1 year, is property, plant, and equipment, part, equipment. Air conditioning is going to be used more than 1 year, is property, plant, and equipment within equipment, okay? Monitor, used more than 1 year. Property, plant, and equipment within equipment, okay? Now, this table here is going to be used more than 1 year, but falls in the category of furniture, okay? So all of these are, everything you see around you is long-term asset. Short-term asset will be the marker. I'll use it for a week or two, and then I'll throw it. When I throw it, we call it expense. The supply becomes expense. Okay? In our office, we got a lot of supplies. Water, we're going to drink within a year. Coffee, we're going to drink within a year. Now, the glass and the plates will last maybe 3 years, maybe 10 years. These are long-term assets. Okay? So, you always ask, am I going to use it within a year or less, or more than 1 year? And the answer, year or less, you put it as current. And that's all there is. Examples will be, and they just give you some company, K2 Inc. I mean, these are all major popular companies in the United States. K2 Inc. And they just give you a little bit of the balance sheet. And here in the balance sheet, they say property, plant, and equipment. And they have, example, land and land improvements. 6, it's going to be, I don't know, million in thousands. Okay? Next one, buildings and leasehold improvements, 55 million. Next one, machinery and equipment, 204 million. And construction in progress. For example, university will be building a new dorm, and it takes maybe 12 months, maybe 16 or 18 months to build a big dorm for, let's say, 500 students. It will be construction in progress. When it's finished, it will become building. Okay? And this is just an example of one company. So what we do here is theory, example, theory, example. Example of property, plant, and equipment. Next one. Next one is called intangible assets. So open dictionary, and let's try to translate what is tangible. And tangible means you can touch, you can feel. Keyboard, table, camera, shirt. These are tangible. You can touch. So try to translate first intangible or tangible. Translate. Loud, loud, loud.
สัมผัสได้พวก tangible นี่จับต้องได้แต่ intangible จับต้องไม่ได้
Okay, you understand? So intangible, you cannot touch, you cannot feel. Examples of intangible I will do now is patent. So now we gotta start working on translations. Patent, you own a particular product, a particular design, or a particular process. Dictionary translation. Loud? Okay, you understand patent? Yeah? Next one is trademark. Trademark is a special name which you recognize. You'll recognize the trademark iPad. You'll recognize the trademark iPhone. You'll recognize the trademark Galaxy. Okay? You recognize these. These are trademarks. People know them. Sometimes trademarks will include brand names like Samsung, Toyota, Honda, all of those names. So these are trademarks. Next one is going to be copyright. And copyright is the right which you own for a particular book, for a particular song, which is music, for a particular movie, for a particular opera, and other things, in a sense which you could copy or you could not copy. You can copy a movie, so the movie will have a copyright. You can copy textbook or book, it has a copyright. You can copy music, it will have copyright. So, if you own the right to copy, you have a copyright. Next one is, you're quite familiar, franchise. Franchise is a brand name of a business, and when you pay a franchise fee, you can use that particular business. You have a lot of franchises here in Thailand. I'm seeing here McDonald's is a famous franchise. Burger King is a famous franchise over here. You guys throw more names. A little big one, 7-Eleven. Okay, maybe a franchise, maybe not. Starbucks, very famous. Pizza Hut is also a franchise. So you understand these franchises. You pay to the business the franchise fee, and you make it just like the way it is. Yes, Subway. You know Subway? Make the sandwiches. Yeah, that's an American franchise. And let's see the last one. I don't want to discuss. It's very tricky. It's very difficult, and I will not discuss here in class. You don't need to study goodwill. That's for another accounting, your next accounting class or for your finance class, not this one. So here, let's go back to the company is Time Warner. Time Warner is a big company. It's a media company, and they got film libraries. They got a lot of movies, and that library is going to be worth a lot of money. Okay. They also have customer lists. So customers are valuable. If customers pay, a customer list will have some value. Cable TV franchises. So they have cable TV. They sell franchises. You got sports franchises. You got brands, trademarks, and all the other things. You girls may have to separate again a little bit. Yeah, just move the chair a little bit. Yeah, a little bit more. Okay. Next one's going to be on the light. They have turn on and off the light. Okay. Right, that's going to be the penalty. Turn on and off the light. So, these are Time Warners. And Time Warners will have some brands, it's going to have some trademarks, it's going to have some intangible assets, a whole bunch of them. This is an example of an actual balance sheet of a real company in the real world. Review question, nothing really interesting. So, all with it so far was covered the assets. Current assets and long-term assets. Now we go through liabilities, and then we got a little bit for the equity. Liabilities are current, and current means you will have to pay within 1 year, within the next 12 months. So if you got to pay within the next 12 months, it's a current asset. It usually has notes payable first, then you have accounts payable, so you're going to later on have salaries payable, taxes payable, whatever payable you have to have within the next 12 months, you put it in here, okay? And the other items, they follow in order of magnitude. And you also list them according to liquidity. Liquidity is the ability to pay obligations expected to be the next year, not too important. For you, I'm expecting you to have a clear understanding what is short-term and what is long-term liability. And I'll provide an example over there. So, current liabilities will be notes payable, account payable, current maturities of long-term debt. Let's try the word maturity. Maturity means a day when you have to make a payment. The maturity for my motorcycle rent is the 20th. So, May 20, I pay rent. June 20, I pay rent. July 20, I pay rent. August, September, October, November, on the 20th of every month, I pay my motorcycle rent. And on the 1st of every month, I pay my rent for my apartment. Okay? So, maturity is simply the due date when you have to pay an obligation, whether it's rent or debt. So, if you have a long-term debt which matures this year, meaning within 12 months, you put it as a short-term debt. So, before it was 5-year debt, so it's a long-term debt. After 1 year, it's 4-year debt, it's still a long-term. After 1 year, 3-year debt, it's still a long-term. After 1 year, it's a 2-year debt, it's still a long-term. And after 1 year, becomes a 1-year debt. And when it's a 1-year debt, you move it to short-term debt. Okay? And you got accrued compensation. Compensation in English and in law is the same as salary. So when they say compensation payable is pretty much the same as salary payable. Of course, you may have other compensation besides salary, but here to compensate means, things you gotta pay to the employees. Again, short term and accrued. We already studied what accrued is from accruals. Long-term obligations. Long-term liabilities is long-term debt. Debt you must repay within more than 1 year. You may have other liabilities, and then we get to capital lease. So now we need dictionary, translate lease, this one lease. And lease is when you rent some property or equipment long term. You can rent the airplane for 3 years, or you can rent the airplane for 5 years. You can rent a car for 1 year, for 3 years, or for 5 years, okay? Now, I'm renting my motorcycle on a monthly basis. So when it's short term, you call it rent. When it's a long term for a fixed period, 3 years, 5 years, 10 years, it's called a lease. Can you translate lease?
สัญญาเช่า
You understand? Okay. So now, what is a capital lease? A capital lease is a lease which will transfer the ownership at the end of the lease period. So, example, when I was in the United States and I did my doctorate, my PhD in the United States, I did between 1995 and 1999. In 98, I saw, okay, I'm going to be able to graduate, and within 1 year, I'm going to have a good high-paying job. So in 98, I leased a Ford Mustang. It's a nice sports car, and a 5-year, it's going to be capital lease. Sometimes they call it lease to purchase or purchase lease. Capital lease is the same as purchase lease. And they say, every month you pay us $273. This includes the insurance. And at the end of 5 years, if you pay us $6,000 cash, you become the owner. And I said, okay, I'm going to pay $273 for 5 years. This includes the insurance and all the other expenses. And at the end of 5 years, I pay $6,000 cash, and I own it. Own it means they transfer the title of ownership from the bank to my name. Well, I was paying for 3 years every month without exception. And at the end of the 3 year, I was already working, I was having a good job, I saved a lot of money, I had over $10,000 saved. At the end of the 3rd year, I called the company, the leasing company, meaning the owner, said, hey guys, I have a Ford Mustang, which I'm leasing from you. How much do I owe you? How much money can I send you to have it my own? And they said, oh, you have been paying for 3 years, you have a remaining balance of $9,000. If you send us $9,000 and let's say $250 for all the paperwork and documentation, if you send it within 30 days, we will transfer the car on your name within about 2 weeks. And I said, okay, please fix the payment of $9,250. I'll send it tomorrow. You take care of the paperwork and send me back the title, okay? And that's a capital lease. The meaning of capital is if the title will be transferred at the end of the lease. They usually do this with airplanes. They'll give you the airplane for a 5-year lease, and after 5 years there will be some remaining amount, and that remaining amount, when you pay, you own the airplane. In the meantime, it will be owned either by the seller or usually by a bank. And that's a capital lease.
Capital is when you get the ownership.
Capital lease is a lease with the intention to transfer ownership at the end of the lease. Okay, that's a capital lease. But if you just buy the motorcycle now and you make payments, then it's a purchase now. The ownership is transferred at the beginning, and what you have is a loan. You make loan payments. Usually a bank will give you a loan, or the seller will give you a loan. So the difference is whether the ownership is transferred at the beginning or at the end. With a lease, you have a fixed period, 3 years, 5 years, 7 years, and with a capital lease, at the end of the 5 years or the 7 years, at the end of the lease term, you transfer ownership. And you specify in advance how much is the payment to transfer the ownership. Okay, review question, not very interesting. Okay, this one is more interesting. Owner's equity. And owner's equity has two items. One is called common stock, and common stock is what the investors invested, and the other one is called retained earnings. So let's explain now retained earnings. When you have profit, you can do one of two things with a profit. The first thing is you can withdraw, meaning when you create a new profit, you can do one of two things. One is you take it out of the business, and the other one is you put it back in the business. When you take it out of the business, we say you withdraw, it's a withdrawal. The owner uses it for spending, for shopping, for vacation, whatever they do. The other one is when you take the profit and you don't withdraw, you put it back in the business, we call it reinvestment. So, dictionary translate to reinvest. Is called reinvestment, okay? And this reinvestment is a special type of capital called retained earnings. So reinvestment translates. So retained earnings is a profit which you reinvest in the business. It's the profit that's reinvested in the business. Okay. Sometimes this withdrawal in finance, not in accounting, in finance, they sometimes call payout. Payout. So money is either paid out, meaning withdrawn, or reinvested. The reinvested part of the profit is called retained earnings. Okay? A different way of saying is the same thing, is that you have capital. And you have only two sources of capital. The first source of capital is investors. So, investors invest in the business, okay? You say, you put in 50,000 out of your own money, or you find a partner, or somehow you find investors. And the other way to grow your capital is profit. So, the two sources of capital are investors and profits. The investors we call external sources of capital, and we call this external growth, and profit is internal. And profits, reinvested profits, represent internal growth. So, to grow a capital means that, to grow a business means that capital grows, and capital grows either by attracting more investors in the business or by generating more profit and reinvesting it in business. Okay, that's elementary finance, which you will need in your next finance and accounting course. Okay, well, this internal profit we simply call retained earnings. Okay, and with this, let me see if we got anything else to complete for today. And to give you an example of Nordstrom, is a major well-known luxury retailer in the United States. It only shows you common stock. This is essentially the money you raised from investors. It's similar to the external sources of capital, and retained earnings is the internal sources of capital. How to grow your own business. They call this organic growth, the source of organic growth. Discussion question, reversing entries we don't have to do. I'm not going to ask. You don't have to study the reversing entries. You got an example of reversing entries. And